Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we are testing our live feature, and it's something that we hope to incorporate going forward. Well, you'll get this live, and then we'll have the recorded version that you can watch later on that night. So today's our favorite day, the Primary Vision Frac Spread Count. And before we get started, we'd like to remind you, please like, share, subscribe. And now, without further ado, to get right into it, before we go into the number, what are we going to talk about? We're going to talk about what is the number, what does it mean going forward, what's happening with rigs, what's happened with some of the refined products around the world, how are those balances changing, and then we had a decent economic data dump that we want to go through briefly and then we'll do a deeper dive, obviously, as we head into the econ show next week. So now, as we look at it, the numbers came in at 271. So we fell by a whopping total of 3. Now, when you look at where some of these different breakdowns were, the 3 that fell off, it was really in just the smaller basins. So when you look at a lot of the main basins that we've been talking about, they've all been stable: Williston, Western Gulf, Permian, Anadarko, Appalachia. So everything for the most part, as we said last week, and again, we obviously didn't have our show, so I just talked about it on Twitter, was that we expected to start to see these smaller basins start to roll over, and then we'll see that accelerate a bit, because typically either last week or this week is the top before we start to see a rollback in activity. And again, all fully seasonally normal. This is normally what happens between Thanksgiving and the new year, and then we see a strong snapback that's typically by the second week of January. So we should see another decline, maybe another 20 or so spreads coming off. That will again accelerate as we head into Christmas with the week between Christmas and New Year, that biggest decline so far. But then when we look at rigs, rigs were fairly stable. So where did we have rigs? Everything was fairly flat. We had 3 directional come off, 3 vertical come on. So, but net, we had an increase in the Permian, and that's where we're going to continue to see activity as they try to build the DUCs, or the drilled but uncompleted wells, to make sure that we can start off 2022 as strong as possible. The little reduction came in the Gulf of Mexico, but again, there was not too much to write home about. There was a net 2 rigs that came online when you look at just the land. But again, when we're talking about net between the Gulf of Mexico and onshore, it was a 0. So it's still something to be excited about. We have continued activity, and one of the things that we'll talk about briefly, and we discussed it in our insights, is that front end of the curve. This is something that we talked about during the EIA show. When you look at the curve in general for crude, it was really the front month that had that drop, as the back end held fairly firm. And that's when we start discussing what is investment going to look like. And we talked about it in segment 1 of the econ show, looking at what is happening with E&P investment. We do expect that to go up again in 2022. We have the UAE adding another $127 billion to exploration over the next 3 years. So again, we expect to hear more about that as we go forward, as we get some stability through the back end of the curve. Now, this is just rehashing something that we talked about on the EIA show segment 3, because remember, we made a call, and I made a call 2 days ago, but that Russia was going to be over 4 million barrels a day, and here we are just over 4. And remember, the Angola comes online first, so we get Angola that posts their loading schedule, and then Russia with their Urals as last. So we still have a little bit more time to see some loading schedules put out there. We expect another, let's call it 80 to 90,000 barrels a day to be added, but still right within this kind of comfort zone. Now, Nigeria on the other side is the one that you can see a big drop between July and August, between November and December. But now when we come to the other side, you see that nice snapback in January. And that's because you saw deferrals already coming out of December into January. But even at the reduced December level, they still have cargoes available. They still have 8 million December cargoes unsold, 8 million barrels of December cargoes unsold, and 40 million in January. While Angola has gotten fairly stable, they've had a steady move, but again, it's at a very reduced level versus what has been previously talked about. So when you look at Nigeria, they're at a reduced December and they still can't sell. And remember, this is what they're doing, this to clear some of that big glut that we talked about on the floating storage. So this is where we see some of that conflict when we're talking about what is oil demand looking like and how is that shaping up in Asia, because West Africa, especially Angola, would go to Asia, and Nigeria has been going more and more to India. So we still haven't seen all that much activity. Then when we turn to Libya, we expect that to come up to about 1.12 million. And again, not too much to say otherwise. Now, when we go a bit further and we look at run rates. So here, when we look at China, because remember, we're seeing some of this dynamic shift between what's happening in Asia, what's happening in Europe. And right now you see that China is slowing down a bit on the teapot side. You can see that we're at 67.7% on a run rate. Then that's just looking at throughput. We were closer to about 69. So we're still seeing that steady walk back. But then on the state-owned side, we're seeing a little bit of an increase. So that's where we're getting some of that shift. But when you look at what happened over the last couple of weeks, there was a big push to make distillate, to make diesel, gasoline. Now, China had placed a ban on gasoline, diesel, and fuel oil exports. They have since relieved that on gasoline. You can export gasoline. And as we continue to see a step up in diesel, gasoline, and fuel oil storage, we expect to see some additional spot diesel cargoes hit the water by the end of this year. Because as we talked in the EIA show, we're seeing a steady increase in underlying storage. And when you look at what is that storage showing, here's where we see crude oil. So when you look onshore, fairly stable. And this is going to be that dynamic between what's happening onshore, what's happening offshore. And we expect some of that offshore crude to continue to flow into the onshore side, but they are reducing rates. So there's really no impetus to go much faster to fill this up. We expect this to be fairly stable, not much to look at. But then when we turn to fuel oil, so not only do we have an all-time record, but we also have that 2021 record. And this was key to make sure that there's enough available for winter. There's been a big push between Japan, South Korea, China, India to make sure that there was enough distillate for that push into the winter months. But now that we're at these levels, these exuberant levels, now you can start to see they can play with some of that storage. This is where we think some of these spot cargoes will get pulled into the market. Now, when we look at what happened in Singapore, we had a nice decline in terms of storage. And as we said during the show on Wednesday, we expected it to happen in resid. We did expect to see middle distillate with a little bit of a bump. Instead, we had a small draw. We expect that to reverse. But then the light distillate had a big build. And this is where we continue to see some of the overhang is on the light distillate or gasoline side, where we're just not seeing all that much demand. But remember, when you make a gallon of diesel, you inherently make 2 gallons of gasoline. So this is putting some of that excess into the market. Now, when we flip to Europe, you can see that there was a small draw on the gas oil side. Again, we do expect that to reverse, but fuel oil is getting stuck. And that's where fuel oil, if you remember, the ARB was open between Europe and Asia, and now it started to close. It's tightened up a bit, and that's putting more on European soil. So we should see some more competitive pricing in order to clear some of this glut, or we'll see it get recracked. It's all going to depend on what do the numbers say. Gasoline had a small build, and this will, again, as the builds increase in gasoline, and not to say that COVID lockdowns are going to happen, but you will see the consumer adjust a bit. And as the consumer adjusts, what are we going to see? That just means that the gasoline builds will increase a bit, and this will open up the ARB, and that'll bring additional gasoline from Europe into the U.S., especially on into Pad 1. Now, when we turn to what's happening in the world today, we all know and we all love to talk about food and agriculture. We hit a new high. We're pushing back into where we were in 2011. And there's still a lot of momentum behind the strength in pricing. When you look at soybeans today, up another $25. Wheat is down a bit, but again, still elevated. And it's not that we're going to see another massive push higher. It's just there is a lot of pressure or tailwinds that is going to lock us in at these highs. And that's why we think that there's a lot of staying power here, and that's just going to increase the inflationary pressure. Now, when you look at what the dollar has done today, again, fairly sticky here above 96. And so now we have the dollar strong. We have inflation that's hitting and biting hard. You have a lot of these emerging markets that are increasing rates. Now you have food prices again. This is just that slow bleed that is going to impact emerging markets the most. So then when we look and say, okay, well, we talked about how things are impacting some of the international world. How do they look internally? And this is an interesting Gallup poll. We'll have more on this as we go into the econ show next week. But people are still seeing hardship. 45% of people who were surveyed said, yeah, things are a little bit tougher. Prices are going up a bit. And even those who are making over $100,000 or more are still seeing, some of them, obviously a smaller percentage, but it's not surprising that when you look at less than $40,000, 71% are seeing some sort of hardship. And this is with rising wages, especially at that lowest quartile. So this is going to be some of those pressure points when you look at how is inflation impacting them and what is that going to do to spending as we go through December and more importantly into Q1 of next year. So then when we take this and look at the fun data dump that came out this morning, when we look at payrolls had came in at 210,000. I'm sorry, the non-farm payrolls came in at 210,000. The estimate was for 550,000. We were expecting something much closer to the 550, and we're going to talk for a minute, and we have shockingly, I know, we have a chart on it. We're going to look at what is the difference between what the survey says on payrolls and what are the household surveys saying. And there's some disconnect there, and it could be timing because of the holiday. But again, this is why we do expect a snapback in December, because there will be some makeup in that number. Then when we look at 2-month payroll net revisions, coming up another 82,000, again, a net positive. Average hourly earnings slowed down a bit. It was expected at 0.4, came in at 0.3, and year over year was expected at 5%, came in at 4.8. And this is what we were talking about, where wages are going to curb a bit. And it's just because the supply pressure is still there. So you still have supply chain costs. And as those costs normalize a bit, some of that will get passed on as wages. So we will see a little bit of a kind of competition, if you will, back and forth as to where some of those additional benefits come into play. And again, we do expect some of those wages to go up, but we don't expect it to keep pace with inflation, which is where that pressure comes, especially on the lower end. And we'll have those additional numbers either by next week or the week after from the Atlanta Fed. And as we always like to look at it based on the different quartiles. So then when we look at the unemployment rate, it went from expectation of 4.5%, and it came in at 4.2%. And this is a positive because it just means more people are coming back into the workforce, more people are finding jobs, and again, a net positive. Underemployment rate also got better, and as the labor participation rate also improved. So again, nets, there's a little something for everyone. If you want to look at the headline numbers, they're a bit soft. If you look at the underlying, things are still improving, moving in the right direction. Again, there's really no reason that there's nothing in here that says they're not going to taper or they're going to slow down tapering. If anything, I think we will continue to see them accelerate with their tapering. Now, when we start turning to the market U.S. services PMI, expectations were at 57, came in at 58, again, right in line. But then ISM service index was expected at 65, and it came out at 69.1. And a lot of the internals were fairly strong. So we want to look at what were some of the big drivers and what were some of the slowness that came in, and we'll discuss that a bit more. Factory orders came in strong, and a reason why factory orders came in strong was because backlogs are starting to clear. So that means new orders are going to start coming through. So again, a net positive for what we should keep seeing. And then durable goods, expectations were for negative 0.5, came in at negative 0.4. Not too much of a surprise there. So now when we start looking at those household differences, so household survey employment exploded to the upside while payroll survey employment, you can see, had that big drop. So there's always going to be something in the middle. We saw this in July. There's typically a snapback in terms of where things are, and it's usually in the middle. It's typically because something was overstated, others were understated, and remember, we did have Thanksgiving. And to be honest with you, when you go back through time, November is always a little sloppy. So it's a safe assumption to say that we should be between about 500,000 and 600,000 add, and I think really right in line with where expectations were. And here's just looking at what's happening with these new orders, because when we start talking about where the employment is, you really need these new orders to be that driving force. And that's why when we start turning to where new orders are, where things are really driving, so stronger at 1% month over month versus the 0.5 estimate. So you're starting to see this move, but you need these orders to get the employment, because how many assembly lines are operational? What utilization rate do I have? Do I need to be working 24/7, 12 hours, 5 days a week? These are the types of things where if you have to add a whole new crew, you're going to go out and hire for it. So now when we look at what the ISM service PMI number is showing, here you can see that on the employment side, it was very strong. And as we've been talking on the Econ show, a lot of the employment data has been fairly robust. So that's why we do think that this is a bit low and it should be a bit higher. So now when we look through in November, new orders, supplier deliveries unchanged, inventory ticked up, but it was still contracting. Prices paid eased slightly. Inventory sentiment at record low as employment rose. So the inventory side is going to keep guys buying. But then when you start looking at prices paid, it only eased slightly. It's still, again, that stagflation backdrop still remains in play. And what does that mean? So let's look at business activity rose to a record 74.6 versus 69.8. That is a net positive contribution. New orders unchanged at 69.7, very strong. Employment highest since April. Then when you look at supplier deliveries, also unchanged at 75.7. So there's still massive supplier delivery issues. So that is going to be a positive contribution, but a negative to the underlying inflationary pressure. So that's going to be a little bit to watch for. Inventory change rose to 48.2 versus 42.2. So still a problem, but getting a little bit better. But again, still in contraction, still need to see some of that refill, if you will. And then prices paid fell to 82.3 versus 82.9. Again, we're not seeing a huge collapse. It's just you're starting to see this balance out, and that's giving way from that inflation again into the stagflation. Now, when we look at what's happening with hourly earnings, here's that small tick, to the sideways. I wouldn't say it's anything concerning. You typically get a little bit of a pause, then we had that reacceleration. This is something where we should see a little bit longer of a pause as people close out the year, see where things set up into December, and then you have that reacceleration in January. When you look at U.S. unemployment duration, 27 weeks, when you're looking at it's changing trend a little bit, but we've had such a strong move down. We expect a little bit of an increase, and again, expecting that to continue to the downside to be fairly bullish. So that's all we have for you today. Hopefully this test went well on your end. We'll do some due diligence. If you have any questions, you can always find me at MarkFNY or in the comments section. We hope you have a great weekend, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.